This is Professor Hazera, and these are going to be, we've already had a video on the basic methods of inventory, which is probably a review of what you had in 201, LIFO, FIFO. But I did it in more detail. I did it with some detail with respect to the income statement. What I'm going to do here is sort of add to some of the rules regarding inventory valuation. And these rules, I'm going to topic in the next 4 videos. I'm going to talk about 2 subjects. One is the write down of inventory, and the other one is the estimation of inventory. Now, the first 2 videos have to do with the write down of inventory. The next 2 will have to do with the estimation of inventory. Writing down of inventory is very important because inventory is a current asset. And we almost presume that if inventory is not being sold, um, first of all, if inventory is not being sold, you're going to have a very low inventory turnover. But if inventory is not being sold, it could be, if it's a tech product, it could be obsolete, which means you're going to have to write it down. Or if it's too obsolete, you're not going to be able to sell it at all. So, and that's why we write down inventory. Inventory is a process. You buy it and you sell it. But if you don't sell it, you write it down. And then if you write it down, you can't sell it even after you write it down, probably write it off. Okay, so your inventory can be a tech product, which is obsolete, or let's say it's an apple, bag of apples, and they can go, they come bad and you can't sell them anymore. So inventory write-downs are sort of a continuous part of the accounting process, inspecting your inventory periodically and making sure that it's that you can sell it, and if you can't, it's written down. And keep in mind, it's current asset. Current assets, you better be able to get rid of it within a year, or the very short term. Okay, so I'm going to give you the first thing I'm going to do is give you the general write down rules, and then we'll go over the first method of writing down. Then we'll go over the second method of writing down. Okay, so if a company uses, and we'll stick with FIFO and average cost. We'll talk about the retail method later on, but it's really not the most important topic. The idea that you have to write it down in the process of writing down inventory is the most important. So if a company uses FIFO, first in, first out, or average cost, or the retail method, which we'll talk about later, then it must use what is called, and it must write down the inventory to what is called either the lower of cost or net realizable value. Okay, and here's a couple of notes. First of all, cost here means what you paid for it. That's pretty obvious. You pay to make the inventory, you pay to buy it, either one. Net realizable value. This is going to be a very important term as we go along here. And net realizable value is the amount that you could realize from the sale of the inventory, which is the sales price, less any costs to sell the inventory, which usually are sales commissions. So it's sales price less sales commissions, maybe some advertisement, but basically it's the revenue that you realize after you pay cost to sell the product. I'm just going to be using sales commissions here, and I'm sure the book has other costs in there, but sales commissions is the classic one. And note 2 is the company can record the lower of cost or net realized value at 3 levels: either the product level, the category level, or the total inventory level. And that's what I'm about to show you. I'll show you in the next sheet here to the right. So just to review, if a company uses FIFO or average cost, then it must value inventory at the end of the year at either the lower of the original cost or the net realizable value. Net realizable value is the amount that the company is going to realize, the amount of sales the company can realize after accounting for costs such as sales commissions that would needs to sell the product. And then once you determine lower of cost or net realizable value, you can actually determine that at either the product level, the category, the inventory category level, or total levels. And I've got a nice example to the right here in a second. Now, if a company uses LIFO, last in, first out, it doesn't use lower of cost or net realizable value. If a company uses LIFO, it uses what is called lower of cost or market. And a detailed example will be shown 2 sheets out in the next video. Okay, so let's start with this first one. We're assuming a company either uses first in, first out, or average cost, and it has to record inventory at either cost, the lower of cost, or net realizable value. Okay, net realizable value is sales price minus any cost that it takes to sell the product, and you can record the cost. You can record the adjustment to the lower of cost or net realizable value at the product level, category level, or the total level. Okay, so the total inventory level. Okay, so let's go here, and so this is um, an example of the lower of cost or net realizable value. Okay, and it doesn't have all the details here, but it has basically I'm emphasizing here the the levels at which you can record this at. Okay, I could put in there like sales minus sales commissions, not, but I'm just assuming here that net realizable value that we've already calculated. Okay, so example: a sporting goods company sells baseball bats. There's two types of baseball bats and soccer balls. Okay, and the cost and net realizable value for each are as follows. Okay, and I chose these because there's two types of there's specific products, baseball types or baseball bat types 1 and 2, and soccer balls types 1, 2, and 3. Okay, and so we've got three levels. We've got product level, which is all these 5 types of different products. We've got the category level of product, which are either bats or soccer balls, take your choice, or we can take the total inventory. So you can compute the lower of cost or excuse me, the lower cost net realizable value at any one of the levels. Take your choice. Okay, so let's go ahead and do that computation, and then I'll just give you the answer, assuming that they choose the total inventory level for maybe that's the best, whatever. Okay, so by product, what you're gonna do here is all you're gonna do is take the least of the cost or net realizable value for each type of product. And Excel has a nice function here. You just take the minimum, take the minimum of one number or the other number. That's the min function, takes the lower of the two. So obviously cost is lower in that case. And you can copy down. Okay, in this case, in the case of type 2 bats, net realizable value is lower. Copy that down. In the case of uh, type 1 soccer balls, obviously net realizable value is less. In the case of type 2 soccer balls, once again, net realizable value is less. But in the case of type 3 soccer balls, the cost is less right there. Okay, so we're going to compute the totals here down here. Okay, now so we'll be able to that's the lower of cost or net realizable value by product. What we'll end up doing is you can add this up, and you can add these up, and we'll get a total down there. We'll compare the two and take the lower. Okay, now by product category, there's only 2 categories of products they have, and this is going to be the minimum of. You can use bats. There's the minimum that would be obviously the total cost of all the bats, which is lower than net realizable value of all the bats. And then we can come down here and we can use, we just copy this equation down here, and we can use, it's going to be the lowest, it's going to be net 208. So we can use category. So we're going to either use, we use products category, or we can use total inventory here. Okay, and the total inventory is, we're just going to sum up all these numbers coming across, and then for the total inventory, we're just going to use the lower of those 2 numbers there. Okay, so let's go ahead and take the total sum of, well, we can just take the sum of the bats plus the sum of the balls. The total cost of all our inventory is $400,000. The total net realizable value of all the inventory is $403,000. Okay, and then we can just go ahead and add up by products, which would be the sum of all these things right here. That's the sum of all those things right there, 379, or by category, which is 190 plus that amount. Or we can take the total inventory. The total inventory would be uh, 400,000. It would be the minimum, excuse me. It would be the minimum, minimum. This is the one we didn't add up. Minimum of the cost or net realizable value of all the inventory, which is obviously 400,000. It's the lesser of those two numbers here. Let's look at the equations again. There's your minimum at the total level. At the category level, it is the category level. It is the total cost at the category level is going to be the lower of cost or market at the category level is 398, and that's the no, remember that what I did was I took the minimum of all the bats. So I took the minimum cost or net realizable value of all the bats, and I took the minimum the cost or net realizable value of all the balls. The total of those gives me the net realizable value at the category level. Now, if you did this by product, for each product, you're going to take the minimum of the net realizable value of each item, and you add them up like that. Okay, so here's what we've got. We've got the cost, the entry to record the actual write down. Let's say that they decided to do this at the product level. Okay, so what? And I'm going to add a little bit to the video here. I'm going to add it just one entry here. There's a couple of rows here, so I'm going to go ahead and just to give you the full picture. Okay, so what would have happened is when inventory is purchased, this is the entry you would make. You just have to record inventory at cost when you purchase it, the actual cost of the inventory when you purchase this. So you would debit inventory. And we'll assume it's for cash. You're going to do that for the actual cost of the inventory. And the actual cost of the inventory is just one, it's the 400,000. So you're going to have, this is equal to 400,000. And this is equal to 400,000 here. Okay. And we're going to do this. We can write this down. We have a choice now. Our inventory is valued at 400,000. And I'll wipe these off for now. I did it at the category level. But so your inventory is actually at 400,000. Now you have a choice here. You have to write it down. You have to write it down. The net realizable value of the inventory is 403. Now, if you're comparing this really at the total inventory level, you just leave it at cost because cost is the lower of it's lower than net realizable value. Keep in mind that we're doing lower of cost or net realizable value. So if you do this at the total inventory level, you're comparing this number here, this 400,000 here, basically, with that 403. Well, the 403 is the 400 that is less than, so you leave it at that. If you decide to do it at the total inventory level. However, if you decide to do it at the product level, you will write it down by 11,000 here because you would be comparing 370, excuse me, at 21,000, but you're comparing 379, which is the net realizable value of the inventory at the product level versus the cost of 400,000. Okay, so I'm going to say an appropriate entry at the, let's say at the product level, it depends on the circumstances, but would be the difference between this 400,000 here and that 379 because you're trying to get down to the lower of cost to market. So you would write down the inventory by 21,000. So that 429 minus that 21 would give you the appropriate adjustment there if you did it at the product level. And finally, so here we'll insert a couple of rows here. If you an appropriate entry at the category level, we'll do this, and we'll just dip down here. But if you did this by at the, let's say at the category level, which is you computed at the at the might be these two accounts would be the same. Those two accounts would be the same. And you would do it for the difference between the 400,000 and minus the 98,000 right here, which would be 2,000. So that would be your entry right there. Okay, so let's sum this up here. This is the entry is made that is made when you purchase the inventory. That's you just buy the inventory and there it is right there. Okay, and I'm going to put here if the adjustment is made at the total inventory, no entry is needed because the cost 400,000 for is less if there's it's decided made no there's no because the cost is 400,000 is less than net realizable value, which in this case happens to be 403. So just leaving it, if you did this at the total inventory level, you would make no adjustment. You would make no entry. No entry would be needed. I'm going to put that right there. If that were the case, if you decided to do that, that would be the case. Okay, no entry is needed. Okay, now if you did this at the product level, the amount of your adjustment would be that it would be the 400,000 less the 379 or 21,000, and I'll put this sort of in parentheses, it would be 400,000 minus the 379,000 if you did this at the product level. 379,000 would be your net realizable value for the product level calculation. Okay, and that's that right there. And really, it's the 400,000, and you're writing the inventory down by 21,000. And then if you did this at the category level, it would be I'll just copy this down here. And it would be the original 400,000. So it would be basically that right there, less that 398. So and it should be 398. And you have your choice. A company has its choice. They probably first of all, you have to consider writing it down. In this case, they may make the choice of just saying, oh, we'll do it at the total level because at the total level, we don't have any write down because the cost that we paid for it is already less than the net realizable value. It's the lower of cost, net realizable value, so we have no write down. For different reasons, the auditors might make them choose 379 product level, or which would be writing it down 400,000 down to 379, so they take 21 out of there, or write it down by 2,000 if they use the category level, which would be that number right there. So there's your product level net realizable value, there's your category level, and there's your total inventory right there, which is net. This is really what you have right there. 400,000. The cost is already less, and that's why you have this formula in here. The cost is already less than the realizable value, but have no adjustment there. Okay, so I'll put this video up, and next we go to lower of cost or market, which is a real adventure.